The research produced by IQVIA, the global clinical research service business, on the outlook for biopharma M&A provides some very interesting statistics on the current backdrop within the healthcare and biotechnology sectors. Deal activity in 2024 was sluggish, perhaps understandably given the US election year and wider market uncertainties. However, the longer-term outlook remains very compelling. The research firm estimates that total deal capacity of Big Pharma, calculated as the dry powder available to mega-cap global pharmaceutical businesses at the current time, will reach the $1.5 trillion mark this year. And the fact that a patent cliff covering an estimated $200 billion of industry revenue will see potential declines as it faces loss of exclusivity between now and the end of the decade creates an imperative to start replenishing those pipelines. These statistics were echoed in the recent earnings season, with multiple big pharma management teams reiterating M&A as strategically important. Rob Michael, the chairman and CEO at AbbVie, being just one example, referencing investment in external innovation several times in his presentation to investors last month. We therefore explore the sector again with another strategy which looks well placed to benefit from this theme in a conversation with Geoffrey Hsu, partner at OrbiMed and the manager of the Biotech Growth Trust. Welcome to the Investor Insights podcast, hosted by Killik & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killik & Co YouTube channel, or by searching for Killik & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killik.com. Killik & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan, and invest. And you can find more details on the unique ways in which we do that at our website, killik.com. In this week's episode, we were delighted to be joined by Geoffrey Hsu from OrbiMed, the global investment firm that specialises in investment in companies across the life science sectors, and with expertise right through from seed stage venture capital through to large publicly traded companies, as well as in private credit and royalty transactions in this area. Geoffrey joined the business in 2002, having previously worked as a financial analyst in the healthcare investment banking group at Lehman Brothers. Geoffrey is a partner at the company and a portfolio manager on the public equities team, and alongside co-manager Biog-LON, is responsible for the management of the portfolio of the London-listed investment company, the Biotech Growth Trust, ticker BIOG. We've discussed investment in the healthcare and biotechnology sectors with various specialist portfolio managers in the Investor Insights series already. In fact, our conversations on this topic have accounted for a disproportionate number of episodes relative to the weighting within investment markets. This is not by coincidence. For me, it remains an interesting area at the current time, with sentiment at an extremely low ebb due to the uncertainty caused by the new US administration and the impact of a weaker funding environment, which has caused valuations to derate significantly over recent years. Yet the structural elements of the long-term investment case for the life sciences remains firmly in place, and innovation is undoubtedly feeding through the clinic to approvals at an accelerating rate. These factors combined provides an attractive backdrop for return potential for patient investors, and we discuss this and more in our discussion with Geoffrey. We hope you enjoy this conversation, and as always, please do get in contact if you have any questions on any of the topics discussed. Geoffrey, hello. Thank you so much for spending some time for this. How are you doing today?
I'm doing great. Thank you, Gordon, for inviting me to your podcast.
No, thank you for coming on. And so we have this kind of standard first question that we ask everyone on the series, actually, and it just kind of tries to get a bit to know you and kind of how you go about your work, really. So I just wonder whether there was whether it be an anecdote from a recent meeting or something that you've been working on recently, or something you can kind of share just to give us a feel of kind of how you go about things. Is there anything you could give us?
Sure, Gordon. Well, by way of introduction, I work for OrbiMed Advisors, which is a global healthcare dedicated investment firm. We have over 25 years of experience just investing in the healthcare sector. We manage over $17 billion in assets, and we have multiple business lines, a venture capital business, a royalty and structured debt business, and of course, a public equity business, and that's where the Biotech Growth Trust sits. But we have 145 employees globally with over 300 years of investment experience. And so in talking about biotech specifically, we have 6 dedicated biotech analysts, including 2 portfolio managers, myself and my colleague, Josh Gollum, who co-run the Biotech Growth Trust. And I would say that, there are really lots of biotech companies out there that we could potentially invest in. We do have a global mandate. So there are over 1,000 biotech companies publicly traded worldwide, and we do have a true global footprint. So we have actually geographically 12 locations worldwide at OrbiMed, with offices in New York, San Francisco, Hong Kong, Shanghai, London. So that really gives us a nice platform to invest really anywhere worldwide. And so the Biotech Growth Trust has a global mandate to look for the best investment opportunities in biotech worldwide. And so the way we structure the team and our investment process is basically we assign each of our biotech analysts a discrete specific universe of stocks. And that's typically done by therapeutic area. So we'll have one analyst focusing on respiratory diseases, another analyst focusing on oncology, another analyst focusing on neuroscience, for example. And we, take a nice combination of a scientific analysis approach as well as a financial approach. And you do need both of those to invest in biotech successfully. So biotech is a bit of an unusual sector in that most of the companies are not profitable yet. They're taking maybe their lead drug through clinical trials. And a lot of the stock moves are actually predicated on clinical trial results, on really scientific milestones rather than necessarily financial ones. And so I think we pride ourselves in having a lot of deep technical expertise in-house. And so we have over 30 individuals with either an MD or PhD degree at OrbiMed. And so a lot of our efforts are spent on scientific analysis, really determining whether the drug that is being developed has merit and is going to reach the market. And that is, of course, coupled with some detailed modeling that we do on each of those companies to make sure that financially the company is at a correct valuation or undervalued, hopefully, so that we can make an investment. This is a very volatile sector. So there are a lot of what we call binary events where a stock might double in share price on a phase 3 clinical trial result or drop 80% on that same result. So we have to be very mindful from a risk management perspective to navigate those catalysts correctly and making sure that we take the appropriate risk going into those events. But, that's basically how the team is structured. And we're, constantly looking for, the very best investment opportunities in each of the therapeutic areas and technologies in biotech.
Yeah, thank you for that. That sets the scene really well. We might, if there's time, come back and talk about how some of those other branches within OrbiMed, whether it be your kind of geographic locations or the private equity teams, kind of feed into how you do things on public markets. That might be quite interesting to have a look at. But Geoffrey, I wondered whether, just to kind of start things off, I mean, it's clearly been a pretty difficult period performance-wise for biotech, but also I guess the wider healthcare sector in general, really, over recent periods. And something we've been talking about on the series with not just healthcare managers, but across the piece, is this dispersion within the market as well. The kind of difference in performance that you've got from large and some of the small and mid cap constituents of various sectors. But this is, in biotech, it's been a notable feature as well. I just wondered, it's a slightly big question, but I wondered if I could just ask you just to kind of summarize how you're thinking about things generally in terms of the broad opportunity within the sector.
So Gordon, I think we are basically in the midst of the most severe bear market in biotech that I had ever experienced, having spent over 20 years myself investing in this sector. So for the past 4.5 years, biotech as a sector, as you correctly noted, has really been in the doldrums. We've never seen a drawdown in the space that's been so severe, that's been so protracted in terms of duration. And if you just look at relative performance of biotech, if you take the Russell 2000 biotech index as an example, for the past 4.5 years, that index has underperformed the S&P 500 by 120%. So this is record relative underperformance of the sector versus the S&P 500. And there are a couple of things that I think may have accounted for that. Number one, as you noted, there is a large cap bias in the market right now. People talk about the Mag 7 driving the returns of the S&P 500. A lot of the companies in biotech are smaller cap companies. And so small caps have generally underperformed large caps. And then, as you noted, healthcare as a sector, especially over the past 18 months, has really underperformed the broader market as well. So biotech, or especially small cap biotech, is sort of hit by both of those factors, and so we've seen some, frankly, record underperformance in biotech. But what gives us great confidence and conviction that this sector should have outsized returns going forward is the fact that this latest drawdown, this protracted drawdown that's happened over the past 4.5 years, has really driven absolute valuations for the sector to unprecedented lows. So if one just takes a very objective measure comparing the market caps of these companies to the net cash that these companies have on the balance sheet, and plot the median market cap to net cash for the industry, recently over 25% of the publicly traded biotech industry is actually trading at market caps below the net cash on their balance sheet. This is a really anomalous situation. We've never seen anything like this before. And so the absolute valuations of the space, and I would tell you that on this metric, we're trading at levels below the great financial crisis, below the dot-com bust, really, really record low levels. That those absolute valuations are really unjustified relative to the fundamentals of the sector. So the fundamentals of the sector are extremely strong. We're seeing record innovation. We have a very constructive regulatory environment, lots of great technologies, showing good proof of concept in clinical trials and making it to market. So we have a massive disconnect right now between where the biotech sector is trading from a valuation standpoint and where the fundamentals really are. And so I do think this sets up a very nice opportunity for those who are interested in getting exposure to this very interesting, innovative sector to get some outsized returns over the next several months.
Yeah, no, thank you for that. There's some really interesting stats in there. And Geoffrey, I wondered if I could ask you just to maybe summarize kind of against that backdrop, I guess, how you're currently positioning the portfolio. I wonder if you can maybe talk us through if there are any kind of key themes to where you are exposed. Actually, maybe interesting to highlight any that you're currently avoiding. Are there any kind of key themes within biotech that you're currently positioned towards?
Yeah, so the Biotech Growth Trust does have a small cap and mid cap bias. If you look at the fundamentals of the industry, about 2/3 of the R&D conducted for the biopharmaceutical industry is actually conducted by these smaller emerging biotech companies. And so we are biased towards those companies in the portfolio. But another reason for that is because on a relative valuation basis, the small and mid cap companies are where we're finding the most value relative to the larger cap companies. In terms of areas where we're focused on, frankly, innovation is occurring across all areas of biotech. So we have exposure in oncology, in neuroscience, in respiratory disease, in the whole panoply of therapeutic areas. I would say in terms of things that we're avoiding, it is true that since Robert F. Kennedy was appointed the head of the Department of Health and Human Services in the United States, he's a noted vaccine skeptic. We did exit all of our vaccine company names just because we think it's very unclear at the present time exactly what is going to be required in order to get a vaccine approved. And we just wanted to sidestep some of that policy uncertainty. Another area that we've avoided of late is the gene therapy area. I think it's a very interesting technology. Basically, this is a technology where if there's a disease that's caused by a genetic mutation, the promise of gene therapy is that you can administer this gene therapy, cure the genetic defect or remedy a genetic defect, and basically cure the patient of the disease with a one-time treatment. So there has been a lot of progress in that particular area over the past 5 to 10 years. We do have some products on the market, but there have also been some safety concerns. Most recently, a company called Sarepta had a very promising gene therapy for a rare muscle disease called Duchenne muscular dystrophy, was supposed to be a multi-billion-dollar product, but recently had a couple of patients die due to acute liver failure. So, we think the technology is going to improve over time, but, given the safety concerns and some of those aspects, we have less exposure to that particular area of biotech at the current time.
You mentioned in that very first question I asked about the advantages that OrbiMed's kind of wider capabilities can give you in managing your focus on kind of public equity portfolios. And I wonder if you can maybe talk us through, are there any kind of recent examples of kind of that in action, whether it's the private equity guys giving insights into deal flow trends and that sort of thing. And I've also heard you talk about Chinese innovation, and obviously you've got the offices in Asia kind of working away there. Are there any kind of examples you can give us from those?
Yeah, so I think having a very robust private equity team effort at OrbiMed really does help our public equity investing effort. So certainly, in terms of looking at IPOs, invariably my private equity colleagues have probably looked at that same company at the private stage multiple times. So I can certainly draft off of the diligence that they've done on that company when evaluating a new IPO. If any of the companies in our private portfolio do go public, we in the public team will get preferential access and allocation to the IPO, given that we're already existing investors on the private side. So we have the opportunity to get a nice allocation to an attractive IPO if we want, if we were a pre-existing investor. And then I think from just a due diligence perspective, a lot of the competitors to the publicly traded biotech companies are actually private. So the fact that I have, a team of 50 dedicated professionals on the private equity business, looking at all of the private companies across the landscape, they can give me some insight as to what the competitive landscape may be for some of the public companies. I do think also that we are, perhaps unique and differentiated from other managers in the sense that we do have a China effort. So we have offices in Shanghai and Hong Kong. I have three dedicated public equity analysts based out of those offices, in addition to an Asia private equity team that's been there since 2008. So we've had a long-standing presence in that region. And the reason that's important is because over the past 5 to 10 years, we've seen really substantial, impressive emergence of biotech innovation in China. So the level of innovation that we're seeing in Chinese biotech has hit record highs. It really rivals the innovation we're seeing in the United States. They can conduct clinical trials, early stage clinical trials, half the time that it would take in the United States at a fraction of the cost. So there are, financial advantages to conducting initial proof of concept trials in China. And we are fortunate to have a dedicated team who can conduct due diligence on the ground, visit those Chinese companies, and really identify some very attractive investment opportunities. And China biotech, if you look at sort of the indexes so far this year, have done quite well this year in particular. So that's one aspect that I think differentiates us from some of the other managers. Close to 25% of the Biotech Growth Trust portfolio today is actually invested in China biotech.
Merger and acquisition activity, M&A activity, is always quite a big feature of the biotech sector in particular, in kind of it forms quite a big part of the kind of long-term investment case, particularly for a strategy like yourselves, where you've got the kind of smaller mid-cap bias or exposure there. I wonder if you can maybe talk us through kind of how you rate the prospects for M&A activity at the current time, and are there any kind of general themes to where you're expecting or who you're expecting doing deals over the coming kind of next phase?
Yeah, so currently there's quite a bit of urgency among large pharma companies to make acquisitions in the biotech space. And that's because a lot of the blockbuster drugs for these companies are due to lose exclusivity, meaning that they are going to be subject to either generic or biosimilar competition by the end of this decade. And they need to find some way to offset that revenue cliff, if you will. And they're going to do it by acquiring attractive biotech companies with assets that can deliver and help replace that revenue. So we have seen a nice cadence of M&A transactions in the biotech space over the past 12 months. We do think it's going to continue and perhaps accelerate over the coming 12 to 18 months. And really what the big pharma companies are looking for, generally speaking, they're looking for de-risked assets. So sort of post-phase 2 proof of concept assets that have the opportunity to generate multi-billion dollars in peak sales potential, at least $1 billion, if not more, because they really need those multi-billion dollar products to move the needle at some of these larger pharma companies. And they're really going to be focused on companies that truly have a first-in-class asset, completely novel mechanism of action, maybe demonstrates efficacy that's better than standard of care, or a best-in-class asset where maybe they're not the first to market, but have a better profile than whoever the first in-class player may be. And those assets should fit into whatever particular therapeutic area strengths that large pharma company might have. And they're also looking for strong intellectual property so that the runway in terms of the revenue that they can garner from such an asset is going to be fairly long. So we do expect there to be, again, a lot of M&A activity over the coming months. We have seen quite a bit of that. And in our portfolio, the Biotech Growth Trust, we do hold a number of companies that we think would make great, attractive M&A targets for large pharma. And so as a shareholder of this portfolio, you will benefit directly from that M&A activity.
Jeff, you mentioned in an earlier question about RFK Jr.'s impact on, specifically on the vaccine industry, or potential impact on the vaccine industry. I guess it's been the kind of US administration policy, or the rhetoric coming out of the US has been kind of a big impact on this sector, perhaps, and certainly has had an impact on those relative returns that you mentioned right at the start. Could I ask you to maybe just kind of summarize how you're viewing the potential impact on the sector from what the administration is currently saying, and also, are there any other kind of things that you've done to navigate this period? You mentioned the kind of avoidance of the vaccine sector, but how else are you kind of navigating this period?
Sure. So the biotech sector actually started recovering going into Trump's election in late 2024. And basically, what cut that recovery short was the fact that a number of new sort of political risks emerged post-Trump's election. The first, as you mentioned, was the appointment of Robert F. Kennedy to head the Department of Health and Human Services. That was a bit of a surprise to most investors. People thought he might have a consulting role or an advisory role, but not become the actual Secretary of Health and Human Services. As I noted earlier, he is a noted vaccine skeptic, and there was a lot of concern that he wasn't going to be science-based. Maybe this was going to significantly impair the actions at the FDA. What I would say there is that, yes, I think vaccines in particular, which is clearly something that he feels passionately about, I think there is some risk there to new vaccine approvals. But outside of vaccines, if you just look at therapeutics and drugs, where basically all of our other basically all of our investments are focused, we don't think there's going to be any adverse impact from RFK on drug approvals. And in fact, the FDA commissioner that was appointed, Marty Makary, does seem very science-based, very reasonable, and has mentioned multiple times publicly that he actually wants to expedite drugs to market. He wants to increase the approval rates, get things to the market faster. Recently, he actually said that he was hoping that the number of drugs approved in 2025 would be 20% higher than the number of drugs approved in 2024. And we have seen thus far really no adverse impact on drug approvals since RFK took the helm at HHS. The another concern that people had was, frankly, the budget cuts that Trump has announced across the government. Everyone, of course, is aware of the Elon Musk Doge initiative. There were budget cuts that occurred at the FDA. But importantly, the both RFK as well as Martin Makary has basically emphasized that those cuts did not occur in the drug review function of the FDA. And in fact, we have not seen any notable delays in drug approvals as a result of those budget cuts. So that had been another concern, I think, from investors that I don't think really has come to pass. And then lastly, I think, there's obviously been a lot of talk about tariffs, about drug pricing. Trump did announce an executive order calling for what he calls most favored nation pricing for drugs in the United States. Basically, Trump is very upset that the Europeans pay a lot less for drugs than the U.S. government and U.S. consumers, and he wants to equalize that pricing. I would note that he introduced a similar executive order during his first term, and it really didn't go anywhere. This time around, I'm not sure if it's going to go anywhere either. We are of the belief that any substantial pricing reform in the United States would actually require a bill from Congress, legislation from Congress, and we think that's going to be very difficult to pass. So we think that's sort of a little bit of an overblown fear that investors have. And then lastly, on the tariff front, Trump is his a tendency tends to throw out a lot of numbers very loosely. So he was talking at some point about 200% tariffs on pharmaceuticals. But I would just note that recently in the framework agreed to with the EU, he capped everything at 15% tariffs, and that would include a pharmaceutical drug sourced from the EU. If you look at the cost of goods sold for drugs, it's actually very, very low. Gross margins for drugs are generally, 85% or higher. So even if there is some, tariff assigned to some of those cost of goods, it's not actually going to affect the profitability of these drugs to any appreciable extent. So basically, my conclusion from all of this, so the conclusion from all of this is that there were a lot of policy uncertainties that took place post-Trump's election that basically cut short a nascent rally in biotech and caused prices to dip again. But we think a lot of those uncertainties are actually really overblown in terms of the impact. And I think people are beginning to recognize that. So we should see a nice recovery in the sector. We are starting to see that over the past couple of months as people realize that those policy risks are really not as severe as initially feared.
Yeah, thank you for that. Some really important points in there. Thank you for cycling through all of those different points. We've got a bit of time here at the end. There's this kind of standard final question we have to these as well, and it asks the speaker to highlight if there's kind of one particular area of their kind of investable universe that they have a particularly high conviction in at the moment. I wondered if there was one particular area of biotech or an area of innovation that's kind of coming through that you're particularly optimistic about at the moment.
So I think what I earlier identified in terms of the China opportunity is probably one of the key fundamental themes in the sector right now. If you just look at the percent of clinical trials in the biopharmaceutical industry worldwide, about 30% of the clinical trials right now in the industry is being done by Chinese companies. That is above the 20%, being done by European companies and approaching the 35% being done by US companies. So just in the past 5 or 6 years, China has really risen as an emerging powerhouse in terms of biotech innovation. And that's because back in 2015, China announced as part of its 10-year Made in China 2025 plan that they wanted to develop a very strong domestic biotechnology industry. And so they made reforms to their regulatory processes, accelerated that, increased the standards of the Chinese FDA to that of the West, allowed biotech companies to go public without any revenue. Prior to that, companies really had to show a certain revenue and profitability metrics in order to go public. So really supported the biotech industry. And now 10 years later, sure enough, it has become a real heavyweight in terms of overall share of biotech innovation. So, I think that's an area where OrbiMed is especially well positioned to take advantage of that, given that we do have local analysts based in the region, Mandarin speaking, etc. And we should still, hopefully see continued innovation coming out of that geography, and we'll take advantage of that portfolio.
Yeah, thank you for that. Yes, another example of technological innovation catch up in China. It's not just biotech, but it seems to be across the whole tech space. But yeah, very interesting. Geoffrey, thank you so much for spending the time. It's really interesting to chat to you. Thank you.
Thanks so much, Gordon.
Thank you for listening to the Investor Insights podcast, hosted by Killik & Co. You can get in contact using our podcast email address, investorinsights@killik.com. For more information on any of the topics discussed, or for further details on the services offered by Killik & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik & Co. is authorised and regulated by the Financial Conduct Authority, the FCA.